Season 6 of Franchise Canada Chats is brought to you by the Franchise Growth Lab. When we fail to scale, we limit our ability to leave a mark. Franchises in this country don't have a startup problem, they have a scale-up problem. We can count on one hand how many founders and franchise systems have achieved the 100-unit mark in the last 10 years. At Franchise Growth Lab, we know the right way to scale, and seeing your brand make a bigger impact is what ignites us. Check us out on LinkedIn or go to franchisegrowthlab.com and sign up to receive a free copy of the 10 Habits of Best-in-Class Franchisors. On today's episode of Franchise Canada Chats, we were joined by Paul daSilva from RBC, Joe Pisani from BMO, and Jeff Thomas from Meridian Credit Union. So Travis, I took the day off on this one, so you got an opportunity to get a chat with three bankers. What did you learn?
You know what? You abandoned me on this one. But one of the things I learned is, these guys were great. I'll be honest, I was a little nervous about, talking banking and financing and what franchisees need to know before financing their business. But the information that these guys provided was invaluable for any entrepreneur to listen to, not just prospective franchisees, but we dove deep into what bankers wish franchisees knew in order to get financing for their business. And honestly, too many nuggets to highlight here. People, I think, are just going to have to listen.
So I'm not going to lie, I'm a little jealous. Those who know me know I love numbers, so I'm looking forward to listening to this along with everybody else. So enjoy the episode.
Hi, everyone. Welcome to Franchise Canada Chats. Today, I am excited to welcome to the episode Paul daSilva from RBC. Give a wave, Paul. No wave, Paul. There you go. Joe Pisani from BMO. Give a better wave. There we go. And Jeff Thomas from Meridian Credit Union. I have been looking forward to this episode because really, is there a more important question in franchising than how the heck am I going to franchise, or how the heck am I going to finance my franchise? So grab some popcorn, sit back, and let's let these gentlemen tell us how we can finance our business. And with that, I think I'll jump right into it, guys. If we could just kind of go around the horn here, and maybe Joe, we'll start with you. Just give a quick synopsis of your background within franchise financing.
Thank you. I've actually been in franchise financing now for 16 years at Bank of Montreal. I came up the ranks of actually financing as a lender on the street of the banks, and moved into our department that finances franchises through multiple networks, those that are new and emerging and those that are long-standing that are out there right now. So I've actually lent money directly to franchisees, and I'm putting programs together for those franchisors that need financing for their franchisees.
For their growth. Okay, and Paul, what about you?
So similar to Joe, actually very similar to Joe, I started lending to franchises back in '95. So I started getting my feet wet in terms of how these brands operate and what they look for. At that point, I actually started doing franchise financing, or being part of a national office franchise with Bank of Montreal back in 99, 98, and then transitioned over to Royal. So I've been doing franchise financing since '95, both as an account manager in the field, dealing directly with clients, national office, like Joe was saying, creating programs and understanding the journey of some of these brands. And now, as we begin to transition, is working with some of these larger multi-unit operators in terms of understanding their journey and how these brands are accelerating quite quickly. So it's been a fun ride for a few years.
Excellent. And I don't know, for those of you that are just listening, or for maybe those of you who are seeing this on YouTube, I'm right now on my screen. I'm in between BMO and RBC, so it's probably best I stay there to keep the fighting at a minimum. But Jeff, why don't you tell us about your journey with Meridian Credit Union?
Well, I'm very similar to Paul and Joe. I started out in the field. I worked for one of the big five as a small business advisor and the franchising specialist, basically for the Niagara region. And I did that starting about 2010. And Then in 2017, in somewhere in between there, I joined Meridian. And then in 2017, I started the franchising program at Meridian from scratch. Basically, we'd always help franchisees out on a one-off basis for our members, but wanted to compete with the big boys out there. And we wanted to create programs. So along with my colleague, John Dykeman, we have created now 12 pre-approved franchise programs with the franchisors to assist our franchisee network. And we put together a comprehensive package that's similar to my colleagues here that encompasses everything for a franchisee from the day-to-day business banking needs right through to their financing needs and introduction to our partners.
Excellent. Okay, so I'm coming at this from an angle as from someone who not only is a franchisee but also is in franchise development and walk candidates through the franchise development process to the point of getting financing. And I know, and I might be putting words in your guys' mouth, but I know it can be a frustrating process for the prospective franchisee, as well as it can be a frustrating process for you guys on the banking side, particularly because the franchise candidate or the franchisee doesn't really know what to present to the bank in an effective package in order for something to look attractive to the bank. So Paul, maybe walk me through what a franchisee really needs to present to the banker. And I'm going to say, for anybody listening, take notes here because this is important.
Yeah, and there's really two parts to when you're preparing for going to the bank, and one of them is your business plan. It kind of tells us who the key players are, management, the structure, and all that stuff. But also more importantly is the business plan. That business plan is incredibly, and the projections is understanding the what ifs. And especially now as we come out of COVID, this is a great opportunity to sort of think about what if this happens? What if that happens? What if what happens if my labor, I don't have enough people, or if I have people that suddenly leave? So that business plan and using Excel or using a partner, a professional partner, an accounting firm, or even a consultant that works on these what ifs, to understand what those parameters are. So when you're preparing for that journey to go and get financing, really play around with the numbers, understand what that looks like. And, listening to people like, why should I do a business plan? The business plan isn't for us, right? The business plan is for them, for the clients to understand, this is what I'm going to do, right? So they think about their business, right? As they start to think about this journey, they start to think, I could do this, I could do that. And all you're doing in the business plan is documenting and writing it down. Because once you write it down, there's some credibility to it. And then the next step is the projections. What happens if this? What happens if that? And that's the two things that I would really focus on and being prepared to approach the lender is really understand the nuances of the business, the ups, the downs. But it is scary approaching the bank when you're looking for financing because it is, in a lot of cases, for the first-time franchisee buying their first location, this is a completely new journey, right? They're going down that road.
Yeah. Joe, can you add some color to that?
To Paul's point, they have to understand their business plan, but you don't understand a business plan unless you understand the business itself. So they should be coming prepared. After speaking with the franchisor, they need to be speaking to other franchisees. They understand the ins and outs and the ups and downs. They've gone through a pandemic. They should be giving them some other coaching as well. And they may want to talk to their accountants to see, what do I need to expect when I talk to my banker on the what ifs, as Paul just said. So there's a plethora of information they need to ensure they understand first and foremost before coming to any banker with a package. Because one question that is asked by a banker and puts them off, the banker is going to think that he doesn't understand the business. Why would I want to, finance this individual? So
right. I'm gonna recap that just so I understood that. So when both of you brought up the importance of the business plan, and presenting a business plan, not necessarily to secure the financing. The numbers are gonna help them secure the financing, but what the business plan is going to do is continue to educate that candidate on the opportunity and put them in a better position to answer some of the tough questions that you on the finance side might be asking, and giving you the confidence that, man, this candidate really understands this business model. Is that correct?
Yes, well said.
Yeah. Okay, Jeff, what do you wish prospective franchisees knew before, coming into your institution, trying to finance a new franchise?
Well, I was really appreciating Paul with reciting the Meridian commercial of what ifs. But so thank you, Paul. Appreciate that.
Not a problem.
I guess our money's well spent. Anyway, so the kind of things that I was thinking about, what a franchisee needs to come prepared to the banker. Ideally, the business plan is great too. But the first thing I think a franchisee should know is make sure that the FI you're going to go see has a pre-approved franchising program for that franchising brand, and that they understand franchising and that they understand the brand itself. So that's going to be a real benefit to the prospective franchisee if they're going to talk to a banker that already has a pre-approved program and they understand it. So that's the first thing. Secondly, the franchisee should we need to confirm that the franchisee is meeting the franchise requirements for capital injections. That's going to be really key to helping us understand, what you got to have, and you can prove that you've got it. We also want to know that they understand the business, what's expected of them, what they bring to the table, and that they have some good credit. That's kind of key. And lastly, this is something more for us, but then the franchisee is not going to really know this, but we focus as bankers on debt service. We want to make sure that the loan can be repaid. So I think if you understand your business, the business plan, as they've said, that's your roadmap to get you from point A to point B or point Z, however far you want to go with it. And it's important, as Joe said, Paul said, it's not for us so much, it's for you. It's your guide, it's your document that helps you get there. So it's important that you understand that business.
Right. Paul, you wanted to jump in on that?
Yeah, and Jeff brings up a good point. Like a lot of people go into the banks, where banks or Meridian is I've got to pitch to this banker and try to figure out if I can convince them. Like, don't wait until your business plan is ready and you're ready to get financing. Start having discussions with account managers. Jeff talked about specialists. There are account managers out there that focus on our franchising. Seek them out. If you're entering a new brand or a brand that's somewhat established, the best person to ask is the other franchisees. Who have you banked with? What is your experience that you've got with that banker? To Jeff's point, do they understand your business? And most likely, if it's been approved, that franchise specialist would already have experience, understand the brand, and it makes it easier. At the end of the day, the person coming in to look for finance, they're the customers. And I always get blown away. If you don't feel comfortable with the lender that's in front of you, find somebody else. You have to be comfortable with the lender that's in front of you so that you could have a really open discussion and really talk about the journey, because there are going to be bumps along this road. And if you don't feel comfortable that you can talk to this lender, you're going to have troubles down the road. So to Jeff's point, find that person that really fits your personality and fits the personality of the brand or understands that brand.
Right. So if you're a runner, clearly go to Paul, because clearly he just came in from a race. Joseph, I'm going to pop over to you here for a second to quote first off, to quote Jeff's Meridian commercial, the what ifs, and Paul touched on it in his intro. COVID has changed how we do business, and the pandemic, and understanding that, we don't know if we're done with shutdowns. We don't know if we're, if business interruptions aren't, still going to occur. Can you talk to us a little bit about how COVID has changed the lending landscape and what a prospective franchisee might need to know before going into their potential banking partner?
Well, great question. I mean, and it's a question both on a franchisee, franchisor, and banking aspect. I mean, the banks have gone through 2 years of ups and downs, but they've also gone through 2 years of data accumulation. I mean, they've seen what businesses have survived, thrived, and what has failed. I mean, the banks will continue to use the data for their own uses in getting to the financing of businesses, be it franchises or be it other businesses. The QSR industry not only did well, they thrived and they continue to thrive. They're even building extra businesses out there. It brought out different styles of businesses and franchises in the sense that, the service industry boomed because people could not get out or were afraid to get out of their doors. So, services that boomed were the delivery services, where the home care services actually boomed as well, because you needed somebody to take care of some of the elderly or some of these sick and frail. When you're looking at a franchisee or a franchisor that's moving their franchisees to the different banks, their thought process has to go through: how did we survive? How did we thrive? And if there's another issue, and that being a pandemic, I always say, what happens if they tear up the road in front of you because there's a big, massive sinkhole there and it's there for 6 months? What are you going to do? What is your franchisor helping you with in order to survive as well? And these are the what ifs. It's what is the backstop of you helping yourself out in case of an emergency? What's your rainy day fund look like? It's a matter of everything that has gone through it. What I have to say is the franchisees that have survived have learned, have been able to assimilate in a different situation and can build up on their strengths. Those are the franchisees that every bank wants, because they know that they're going to be able to survive on the next issue that comes about us.
Interesting follow-up question, and you can all chime in. I don't know if it's a fair question, to be honest, but I know in the clients that we work with at the Franchise Growth Lab, I was blown away by the support, by how it almost became franchising's finest hour through the pandemic, and the extra support and the extra communication and the work to get their franchisees through the pandemic. Now, fast forwarding and just expanding on that, do banks or financial institutions, is there more of an appetite to lend to an established franchise brand or a franchise brand than there is maybe someone starting a business on their own? Who wants to take that one?
What's the wording on that? Success breeds success.
Right.
What were you going to say, Paul?
Yeah. Well, and to your point, like, the three of us on the call, and there are other institutions, we really do have a really deep understanding of the brands that are out there, how they're managed, the success, and the performance, that historical performance does really paint the picture of how we want to move forward. Brands that are extremely well performing, we're killing ourselves just trying to go after that business. So that part of it is extremely well. Like, as we come through COVID, like, watching franchise and how it behaves, and this is a comment that was made at the McDonald's convention. During COVID, not a single one of their franchisees closed their doors permanently. Like, not a single one closed. So you look at that going through COVID, different parts of the world, different levels of COVID. There is that level of management. This is really a testament. And Canada is one of the best franchise markets on the planet. These franchisors worked with a lot of these franchisees, and we saw that in how they perform. Bankers historically look at historic performance to determine future expectations. COVID threw that out the window, right? How do you assess the last 2 years to get a picture of what it's going to be in the next? And that's where the expertise of the three panelists really come in, that national office that the banks all have. So it's really that layer of management and how they operated and how they supported the franchises during this period. And that, to me, has been a godsend, because the portfolios have done extremely well. As Joe said, some brands took off, some brands struggled, some brands we helped to nurture along, but we had a good performance, and a lot of the franchises did well during COVID, or they made it through COVID.
Yeah, Jeff, what can you add?
I just want to add to what Paul was saying. I think, and answer your part of your original question is like, who do we really want to deal with? Is it the well-established tenured brands or the emerging ones? And what Paul said is so true in that we can't, if we need to throw out the last 2 years, we need to go back and say what was happening in 18 and 19, and can we extrapolate that into 2022, 23? Like, were they growing when the pandemic hit? And then, we know things happen then, and we can figure on that they're going to go. And a franchise brand that's been around 10 years or more, they've got that historical data. They've been through the cycles, the economic cycles that businesses will go through. Whereas, if it's a new emerging brand, it's only got 2 years before the COVID hit, there's not a lot for us to go on. So I think it's, it was good points. And I think the big banks and Meridian are going to focus on the ones we can help. And we also looked at what the franchisor was doing to help the franchisee during COVID too. I know those are questions we asked of the franchisor when trying to renew a program, was like, what did you do to help your franchisee through this program? We all helped our existing customers and members by, moving payments back or, giving some stuff like that. And the government came up with money, but what did the franchisor do too? So that's important.
Right.
Yeah. And
go ahead, Paul.
If I can add to that, like the question I got in the last 2 years is, has the bank stopped lending? And that couldn't be further from the truth. And as Jeff said, it was harder to figure out what we're going to do because especially for the emerging brands, because we didn't have that history. But that doesn't mean we didn't move forward. We still move forward. I would hope that Joe didn't lend, but the banks were very active. We were in the market. I saw John and Jeff quite a few times in the last couple of years. So we're active in the market. It is harder to understand what's going on because we don't have the history, but we are very active in trying to support this industry.
Right. And I'm assuming that, and Jeff, you raised a really good point, is you're looking at sort of overall performance. And even I don't want people to get discouraged on emerging brands because, there's a lot of emerging brands that have fantastic unit economic models and they've had corporate locations for a number of years and have decided to franchise. And, for people listening or people watching that are looking at emerging brands, I think some of the important points to look at is, how have corporate or existing locations done through other economic downturns? How did they do through COVID, so that you can show a bit of a history of the brand? But I want to switch gears here a little bit, and I'm going to go to you, Joe. If you're familiar with franchise development websites, and different brands have their franchise development websites, or they have their initial communication that goes out to people that are looking at investigating their brand. And I want you to demystify the net worth equation or the liquid capital equation. There's always, you need at least X amount of net worth, or you need this amount of liquid capital. And I'll be honest, out of the Growth Lab, the clients and the potential candidates that I speak to, they're like, huh? Like, what does that even mean? Like, how do you calculate your net worth? How does that factor into the banking relationship?
Well, let's break it down very simple, because Jeff said it right off the bat. It's about debt servicing. So the reason why they are looking for a certain amount of net worth, which would be your assets minus your liabilities, is your net worth. The clarification, though, is what the bank understands your net worth to be, because your assets also include your RSPs, which the bank does not include, because those assets cannot be used, can't be done anything unless you cash them in. And of course, if you cash in your RSPs, you're going to be paying tax on it. We're not talking financial planning here. So if a network is asking for a minimum net worth of $500,000, you own a house that's worth $1 million, you have a mortgage that's $500,000, and you have no other debt, you have $500,000 worth of net worth. That is fine, but that doesn't really necessarily mean that you have the necessary funds to open up that franchise. Because as you go to that franchise and they say you need a minimum of 30% down payment, and it's a $500,000 location, you need a minimum of at least $150,000 to put in. You actually have to get that money out of the bank from your home, and it all comes down to what your own bank is allowing you to do and how much of a loan to value on that home you have. It's interesting because there are brands out there that see that and will honor you a franchise, but they're not digging deep, and they rely on the banks to dig deep on this. And the banks always become the bad people in saying that we can't finance you because you don't have enough net worth. The due diligence comes on all parts, not only the banker, but also the franchisor.
Yeah, Paul, what can you add there?
Well, Joe talked about the what ifs, and Jeff talked about that sort of thing. The amount of equity or cash that you need is really managing the risk, right? So if you're buying $500,000 and you've got no liquidity afterwards to withstand any kind of setbacks, that's a higher risk, and you're going to see these tendencies move back and forth. Really, it's you want to have enough net worth that you could comfortably go into the business, and then you want to have some liquidity in your backstop to sort of make sure that if Joe talked about the street being because there's a sinkhole, you want to have the ability to withstand those sudden shocks to your system. So you want to have that in place. And the one thing that I would recommend is, and like it's always interesting as we see franchisees get all excited about I'm going to get 75, 80, 90% financing. Those obligations are rock solid obligations. The bank is not going to be very, they're not going to be forgiving to be 15 days late or 30 days because it all affects your credit bureau. So having that net worth, having that liquidity creates these cushions and these shocks so that you can withstand these setbacks and that you can comfortably manage your business, get really good at running that business. And then once you're really good at that business, then let's talk about leveraging your business and trying to get the maximum return. Minimize your risk, minimize the shocks that will kill you. And that's kind of, I'll reinforce what Joe said, like understand what you're doing, what your investment, what your needs are afterwards. That's why it's a hard question to answer. We get it asked all the time, but it's hard to answer because every person is different, every business is different, and every brand is different.
If I could add to my fellow panelists here, I think the most important thing is that a franchisee that comes in on day one is tapped. They got no backup plan, no backup resources. That in our mind is the most risky opportunity for us to look at. And as Joe's example of that sinkhole or something else that can happen to you, which you don't foresee, if you don't have the backup plans or the ability to cover those shortfalls in that short period of time, how are you going to survive? Because you're not going to have the cash flow, you're not going to be able to make your payments, and ultimately you're going to end up closing. So for us, if you're going to get into a business, be able to comfortably get into it. Don't have some backup capital reserves to fall back on if projections aren't there, you don't hit those targets, whatever, or unforeseen circumstances like Joe suggested.
Okay, that it's a really important point, and I think something that catches particularly people that haven't gone in for a business loan before, off guard is when the person at the bank fires the question back at you is like, hey, what happens if you're shut down for 3 months? And I think what you're saying, Jeff, is potential franchise candidates that are approaching the bank need to be prepared to answer that question when they come in, and they need to have a solid action plan. I mean, it's planning for contingency. So I'm glad you brought that up. I want to switch gears a tiny bit because we're seeing more millennials, more Gen Z, the Generation Z entering the franchise space, and clearly they're getting financed, and clearly they haven't necessarily built up the nest egg. Maybe Paul, maybe talk about some creative ways that you're seeing young people get financed, and it could be help from a relative, it could be grants, but maybe just talk to me about what you're seeing.
Well, friends and family, or as we refer today, GoFundMe account to help with that equity. Like those are some of for the smaller ones. Like 80% of our small business, and I define small business as anything below $1 million in credit needs. So anybody, or 10 million, 5 million sales, can't remember now. But anything that we consider small business, 80% of that market is serviced by CSBFL, the Canada Small Business Financing Loans.
Right.
That is a great program simply because that ability to have that net worth to back up, and Jeff talked about the fallback position. We're able to sort of use that program to sort of crystallize the value of the security and then look at other ways of managing and helping that business, right? Because sometimes the value of these franchises or the equipment that we're financing, it's hard to liquidate that in a post. So that creates some barriers. CSBFL, or Canada Small Business Loans Financing, that is perfect for small business. And 80% of our book in that small business uses that program. So it is a good program. I know they're revising it, and some of the changes that are coming out will actually help all of us in terms of trying to grow that book. And it's still some of the larger, more established brands have higher dollar amounts. So combinations of how you manage CSBFL and term loans and structure, net worth, cash flows. There's all kinds of things as you start to get into the larger amount, and it gets really complicated. But for your emerging brands, that first-time franchisee, that millennial that's got maybe $150,000, $200,000 that they're thinking about getting into franchise, have a conversation with a franchise specialist, understand the CSBFL loan. That is a really great program and will benefit a lot of the franchises in this marketplace.
Yeah, Joe, what can you?
I think Paul kind of hovered around it, but it is the bank of mom and dad and friends and family that helps them all out, because it is a career choice to get into franchising, and people don't realize it, that being a banker, although is a great career, it's not the first on everybody's mind. Being an entrepreneur, a business owner is typically the number one thing that people come up with. And utilizing the funds that you have initially, as well as those with your family, will help you bring into that next stage. Everybody has aspirations of not having one location, but many locations, and that builds up your business plan there.
Interesting. You know what? I'm going to tie that back to an earlier comment on the business plan. And I'm going to bet you didn't even see this coming. But when you're talking about the bank of mom and dad, or a co-signer, or someone else being involved in your business to help you get the financing, that again speaks to the importance of writing that business plan and understanding that business plan and going through a franchise development process that is designed to educate and inform you, because you are going to find yourself in a position where you're convincing mom or dad or uncle or aunt or grandma to invest in the business, and they are going to ask you harder questions than the bank does. So you need to educate yourself on the opportunity so that you can answer, a potential family member or a potential business partner on the what ifs. Correct?
Yeah, and
right.
And Travis, you're more scared of letting down your uncles, your parents, you're going to be more scared of that than a CSBFL or whatever. So having that opportunity to pitch to your parents and letting them ask the hard questions, because they're the ones that are going to be the hardest questions to ask. And if you feel comfortable in that pitch and that ability to convince your parents, then it becomes a lot easier when you approach, Joe, Jeff, or myself.
Yeah, that's a great point. And I mean, for the younger people listening or watching today, is get past it's like the badge of honor. Oh, I did this by myself. Things are expensive now. Money, even the cost of borrowing is going up. It's no shame to get some help. And when you all of a sudden have $1 million franchise location, you're not going to care, and mom and dad aren't going to care, and no one's going to care that you got a little bit of help at the beginning. So I think it's important to know that a lot of young franchisees, a lot of young business owners did get some help.
If I might add, this what you just said all correlates, even just the home ownership. If I just digress for a second, how many people had to borrow money from their parents to get that first down payments, to get them out of the rental market, get them into the homeowners, build some equity, and go on. I know I did, my dad did, and my son have all done it. So it's kind of the same thing. You want to get this business, don't be afraid to ask for some help from your parents, but you got to sell them on that it's a good investment. Right. Yeah. Just like any financial advisor try to sell, I got $100,000 to invest. well, tell me that it's a good investment for me to do this, right? And I think the point Paul made about the government program, it's a way to save a little bit amount of capital you requirement, because you can get away with like 10% basically down on those deals. So that makes it easier to market with using that program. But if you get that shortfall, maybe you partner up with a relative or someone else. You get a partner. Okay, I got 50 grand, you got 50 grand. Now we got the money we need, so we're partners. Or you get a silent partner in your grandma.
Paul, you had a comment on that?
Yeah, I was going to add, like the idea of reaching out to parents or families or friends to get to look for capital. Don't just stop there. Like, if you look at just the three of us, we got about 1,000 years worth of experience. Talk to the lenders. Talk to the other people that have gone through this process. What did you find out? And the one question I would ask, I have every prospective franchisee, merging or non-merging, is ask the franchisee that you're interviewing to understand if this is the right thing, is, would you do this again? Just the amount of knowledge that's out there, and you're just talking to, like, I've known Joe for a long time. I've known Jeff and John for a long time. Talk to them. We're always at shows. We're always at we've got account managers, VPs that specialize in franchise. Talk to them. Get their opinions. Whether it's accounting firms that focus, law firms, get their thoughts of what that is and incorporate. Don't be afraid to ask the question. What do you want to see? Exactly what we're doing here. Because it's amazing the type of information, all this varied backgrounds, the type of information they can bring together to help you be successful.
Right. Wow. Yeah, that's fantastic. Actually, Jeff, I'm going to come back to you here for a second, and I'm gonna let you go up against two of the big five up in the top of my screen, and I'm not even gonna give them a chance to rebut. So you can clasp your hands, Joe, but I'm not even going to give you a chance to rebut. So, obviously we got BMO, we got RBC, and we have Meridian Credit Union. Can you explain maybe a bit of the differences from borrowing from a credit union or a bank, or if there's, the pros and cons, advantages, anything you want to add there?
Sure. The reality is there's no real difference between borrowing from a credit union and a bank. We basically all offer the same products and services. Anything that the banks can do, we can do. And Meridian, just for those who don't know, is the largest credit union in Ontario and the second largest in Canada. So our pros, the pro about Meridian is that you are a member of the credit union. You're not a customer. And we do things, you have a share, you own a share. So as Meridian, we do everything to provide all the services that they need at a reasonable cost. And we don't have to answer to the shareholders. We don't have to prove that we made $1 billion or $2 billion every quarter and that I'm driving the bank stock up, right? So that's the big pro. That's the big difference. The only con that I can say that, to be fair, is that because all credit unions are provincial, we have limitations. So basically, we have to stay in the Ontario sandbox.
Gotcha.
Now, we can mitigate that to some degree by using our leasing company. So we can finance equipment across Canada. We just can't provide the day-to-day banking in Alberta or BC. So my counterparts there, they have a distinct advantage when dealing nationally. And when we talk to national brands, we position that way. They look, we're not going to be your partner for every opportunity, but if you have a new franchisee or an existing franchisee in Ontario, we appreciate if you give us our offer along with RBC's and BMO's offer, and then let the franchisee make the decision.
Perfect. Okay, we're certainly, this could be probably split up into two conversations, because I got about 50 more questions to ask, but I know we're sort of coming close to the end of our time, and I think I might go around the horn again, but starting with Joe is, again, we're going to have prospective franchisees listening to this podcast, or we're going to have people that are just contemplating, maybe leaving their jobs and jumping into the entrepreneurial space. What's your biggest, and it might be within 0 to 3 months, it might be 3 months to a year, it might be after that. What would be your biggest advice to someone that is looking at jumping in to the entrepreneurial space?
So when I do my presentations, my speeches out there, I usually get somebody asking me what's your biggest advice you can give somebody who's looking into it. And my biggest advice is always go work at a franchise that you want to own. Go and work there. And the reply is always, they only pay minimum wage. I said, the best education you're going to get that pays you. You're going to invest $500,000, $1 million, $2 million, and you're going to get paid for 6 months to learn the workings of a franchise. You may not like it after 6 months. You just saved yourself a lot of time and a lot of effort. And I said, and the franchisor is going to appreciate the fact that you actually worked there, spent time there, and understands that you are going to be the one that's going to be running the business and take care of the business and have commitment to the business.
Have you seen? Sorry, have you seen people take, say, a sabbatical from their corporate job or something and jump into a QSR or something like that?
Absolutely. And you know what? They come back and they always say the same thing. Best advice I got, because I will not buy into that network. Best advice I got, because I'm getting to the network and I'm jumping in with 2 locations right off the bat.
Yeah, and what's interesting about that is what few people realize sometimes, and this isn't meant to, again, scare people that are listening, but what few people realize is when you say leave a well-paying corporate job, or you leave a job where you're making a decent salary and you jump in to your own business, there's a good chance you're not making that salary for the first few years, or the first couple of years. Now, the bonus is you're building equity in that business. You're able to keep food on the table and maybe pay yourself something small, but you got to get used to, for at least a year and a half, couple of years of making less money than you're used to. But so over to you, Paul, without the providing the same advice, what would you for someone maybe that's looking between now and a year or 18 months out from now, what would you encourage someone to really think about?
Well, at the end of the day, the franchisee is our customer, right? So the advice I get them is interview the account manager you're going to be working with. Understand that relationship team, all the services that will help your franchise sort of move forward. And for the account managers, because most likely I know there will be account managers, is be crystal clear of what this franchisee's journey is going to be. Are they a 1 unit? Are they 2 units? Are they going to be 10 units? Understand that franchisee. Understand what their angst is. Are they going to be over leveraged, under leveraged? So for the franchisees that are going out there, interview your account manager. Feel ultimately comfortable. Have a conversation. Create a relationship. Don't wait till the day you're presenting your business plan to say, "Hey, I'm looking for financing in 2 weeks." Go out and have a chat with them. Find out what they're thinking about this brand, and listen to their input. Remember, these are the people that go through a ton of business plans. They're for free. Like, they're sitting there going through business plans constantly, knowing what gets approved. Interview them. Find out what they see as being successful in an application. Understand what makes them tick. Because remember, you want them working for you, but you have to interview. You have to be comfortable. Please don't walk into a branch and get out and ask to speak to a businessman. Create that relationship. Go and talk to a bunch of them. Find one that you're comfortable and continue that relationship. Take it to the left. And if you want, do 2 or 3, just so that everybody knows. A broker once time, every time he sends a submission in, it's going to be 2 banks that are bidding on the business. So we know what's going on. We have to sharpen your pencil. They're the customer. We're the ones trying to earn their right to have their business. So that would be the advice I give franchisees after they've done what Joe's asked them to do.
Right. So what I heard there was use use the people at the bank as advisors in the process. No, that's fantastic. Jeff, what about you?
Well, funny, because Joe took my first thought right off the bat about going to work for a franchise and get mentored by a willing franchisee, or but so thinking that I could be different now in an answer. What I just would suggest is go to the franchise show or the franchise expo. There's so many brands out there. What you need to do is find a brand that you're comfortable, that meet your core values, meet their core values, so that this is the type of business that you're going to be comfortable getting into. And I still believe you should try to go work for one of those brands. Find out if it's for you, and if it is, then yeah, you proceed. If it's not, then move to another one until you find it. That's kind of the biggest thing I could think of, is really understanding the franchise brand that you want to be part of. You got to be passionate about that. That's because you're the business. It's going to thrive on you. They can give you a manual that says if you do all these steps, you're going to be successful. But if you don't buy into that manual, and you don't put your heart and soul and are passionate about that business, you're not going to be successful. So,
you know what? And it's an excellent point, because it's not just about say being passionate about chicken, or serving chicken, but it might be passionate about what that brand stands for in the community, and that brand, and as a corporate citizen, what that brand is contributing, to the world, and that may resonate with you more. So I love that, guys. This has been a blast. This has been a lot of fun. It's been really, really informative. I appreciate not only you, but your respective employers for lending you to us for a little while. So with that, like I said, I think we could go on forever, but I think it's a good time to park it. And for, again, any one of you listening, I mean, these guys are easily accessible. You can see them on the CFA website. You can find them in the membership section, and reach out. You pick their brains. Thanks, guys.
thank you.